In Chapter 14, we talked about how to evaluate divisional managers in a decentralized organization. In this chapter, we will be talking about how we can use transfer pricing to facilitate that process. We already know that decentralized organizations delegate a significant amount of the power to make decisions to divisional managers. This takes advantage of the divisional manager's specialized local knowledge, and it lowers the cost of decision-making from the firm's point of view. However, this process is not without disadvantages. We have agency issues because what the local manager wants and what the firm wants may be different, and this can lead to dysfunctional behavior if the divisional manager makes decisions that benefit the division but not the firm. In the last chapter, we talked about how ROI can lead to suboptimal decisions because the manager may make decisions that are personally beneficial but not in the best interest of the firm. And we talked about how we could use residual income and economic value added to reduce that problem. However, there is another problem that can occur when there are internal transfers between divisions within the firm. And the question is, how can we align the interests of the managers of both divisions with the interests of the firm as a whole? To do this, we use transfer pricing. In this methodology, a transfer between divisions is recorded as though it were an external sale. So, for the division that provides goods or services, it's recorded just like a sale to an external customer, and for the division that receives the goods or services, it's treated exactly as if it were an ordinary purchase from an external supplier. The transfer price is the dollar value that is used to measure the value of the transfer of goods or services between the two divisions. And using transfer prices can be exceptionally helpful in terms of helping managers to make the decisions that the firm would want, and answering the question, how much did it cost this division to provide particular products, and to evaluate the performance of the division and its managers. So, for the selling division, the division that is providing goods or services, the profit on the transfer is going to be the difference between the transfer price and the division's cost of goods sold. For the buying division, the division that is receiving the goods or services, the profit on the external sale will be the difference between the revenue from that sale and the combined transfer price plus whatever cost that division incurs to complete the product. Therefore, the transfer revenue that's recognized by the selling division and the transfer cost that is recognized by the buying division cancel each other out. Thus, from the firm's point of view, their profit is going to be the revenue from the external sale minus the cost of goods from the first division and any other costs to complete the product in the second division. So, Let's take a look at how transfer pricing works. The selling division provides goods or services to the buying division. Without a transfer price, the selling division would be treated as a cost center. It would have no control over revenues. All it would do would be to incur the costs of materials, labor, and overhead to provide services. However, if there is a transfer price, that transforms the selling division into a profit center, and that will change the way that we evaluate that division and its manager. Thus, the transfer price minus cost of goods sold gives us the division's profit, and that transfer price would increase the division's ROI, residual income, or economic value added. On the other hand, for the buying division, since its profit is the external price minus the transfer price and minus the additional cost, the effect of the transfer price is actually to lower that division's ROI, or residual income, or economic value added. So, what is the firm's profit? It's going to be the seller's profit plus the buyer's profit. Since the transfer price increase from the selling division cancels out the transfer price decrease in the buying division, net, the firm's profit is going to be the external selling price minus the seller's cost to provide the goods or services and minus the buyer's additional cost. Therefore, you will never see the effect of transfer prices on external financial reports because they always cancel out. This is not about artificially increasing the firm's profitability. This is about recognition of value. So, how do we choose a transfer price? This is a very important question because the transfer price that is chosen is going to affect managers' decisions by either incentivizing or disincentivizing certain actions. Therefore, that decision is going to affect firm profitability. The best transfer price is one that is going to incentivize managers to make the decisions that the firm would want them to make because it would increase overall firm profitability. For any transaction that would increase firms' profits, that means that the transfer price should benefit both divisions. For a transaction that would decrease firm profit, at least one division's profits will go down. Let's look at some examples. We have a company, XYZ. It costs the seller division $20 to make a component. If that component is transferred to the buyer division has to put in $45 of additional work, and then the finished product can be sold externally for $100. The seller's profit is going to be whatever the transfer price is minus its $20 cost. The buyer's profit is going to be its $100 external selling price minus whatever the transfer price is minus its additional cost to complete the product. For XYZ, the profit is going to be the profit incurred by the selling division plus the profit incurred by the buying division. In this equation, the two transfer prices net out, and the firm's overall profit is the external selling price minus the costs in the seller division minus the costs in the buyer division. And that will happen regardless of the transfer price that is chosen. However, the transfer price is going to affect what managers choose to do. Let's take a look. If the transfer price is $20, that's the cost in the seller division, then the seller division's profit is going to be 0. The buyer division's profit is going to be its $100 selling price minus the $25 transfer price minus its own costs. In this scenario, all of the benefit of the transfer goes to the buyer. Now, what if the transfer price was $55? In that case, the seller's profit is going to be the difference between the transfer price and the seller's cost. The buyer's profit is going to be its $100 external selling price minus the transfer price minus its own cost. It would make no profit. Therefore, in this scenario, all of the benefit goes to the seller division. If the transfer price is somewhere between these two numbers, bigger than $20 but smaller than $55, then both divisions share in the benefit that comes from the profit due to the transfer. And the firm as a whole benefits from net $35 profit from the external sale. Now, what if there is an intermediate market for the component? In other words, what if the seller division could transfer to the buying division, or it could sell the units externally, like this? And what if the buying division, instead of getting the component from the seller, could get it from somebody else in an external market, like this? And then, regardless of whether the buying division gets the component from the selling division internally or gets it from an external source, it will sell the final profit to its customer. How does this scenario affect the optimal transfer price? Let's look at an example. Supposing that for XYZ, it costs the selling division $60 to make the component. If the component is transferred to the buying division, it still requires $45 of additional work, and the final product could be sold for $100. The selling division's profit is going to be the difference between the transfer price and its $60 cost, and the buying division's profit is going to be the difference between $100 and the transfer price and the $45 cost to complete. In this scenario, XYZ's profit is going to be the profit from the selling division plus the profit from the buying division. The transfer prices cancel out, and net XYZ is going to lose $5 on the transfer. That's because the cost in the selling division is sufficiently high that combined the cost in the selling division and the cost in the buying division is bigger than the external selling price. Therefore, the firm will lose money on any transfers between the two divisions. These transfers should not take place unless the company can rethink its cost structure or its selling price.